Most small business audits are self-inflicted. The IRS does not need your tax return to see if they can smell a problem. The IRS knows your industry better than you think. Most audit starts with a computer with no human involvement whatsoever. If your business looks normal to you on paper but abnormal on the paper, you can already smell the problem coming. And this is why my CPA told me this does not hurt. The rule you need to know is this: your home office must be used exclusively and regularly for business. Exclusively means for business. Regularly means you use it all the time, not once a month. And it has to be your principal place of business, the main place where you do the administrative work with your business, or it has to be a place where you meet clients regularly. If you have another office somewhere else, you can't claim both unless you can clearly prove which one is your principal place of business. Can you have multiple offices? Sure, you can claim that. You will have documentation. But using this home office deduction has specific rules, and this is where a lot of people get in trouble. How to avoid this? So if you're going to claim a home office, make sure it's only for business and take pictures to prove it. Measure the room so you know the square footage and keep it clear. No personal stuff, no guest bed, no kid's toy, and no homework on the desk. If you're not sure you qualify, don't guess it. Guessing is how you get the IRS asking questions you cannot answer. I don't claim that deduction anymore because my situation is different and I don't qualify. But you might, depending on your situation and your setup. Just make sure that you know the rules before you claim it, because once the IRS comes back a year later and disallow it, you will owe taxes plus the penalties plus the interest, and that will destroy you financially. And don't think your tax preparer is going to protect you. If you send them an email saying claim home office deduction, they put it on your returns. And now it's your problem when the IRS comes asking for questions. Do not call us and do not click the link below if all you want to do is complain about your massive tax bill. The tax code is over 50,000 pages long, and most of it isn't about punishing people. It's about telling the taxpayer different ways they can deduct their income. In other words, the tax man is telling you all the different ways you can reduce your taxable income. Unfortunately, most people don't have anyone on their side who can actually take the time to look at the tax code and apply it in your specific situation. And the result is the same story year over year. A massive tax bill year after year. And this is where we come in and change the entire script for you. Which part of the tax code actually applies to you and which section gives you the highest deduction based on your situation. Hi, my name is Dhiren, and at D2 Tax, we eliminate the guess part immediately. We fill you in on the current tax code and we go over appropriate steps you need to take, and we get to work immediately. Call us or message us if you're ready to take massive action. Number 3, vehicle expenses. Here's the mistake. People think driving to work is a business expense. It's not. It's called commuting, and it's never deductible. Never. Business mileage is when you drive from your office to meet a client or go to a job site or pick up supplies. Not when you drive to your office from home in the morning. But people don't know this, so they start writing off all the mileages. They email the tax preparer, I drove 40,000 miles this year, and the preparer puts it on the return. The IRS sees it and it doesn't match with their income or their business type, and boom, you have an audit letter. I've also seen people trying to drive 40,000 miles for a business that only made $50,000 a year. The IRS looks at that and says, this does not make sense. How are you spending that much money driving but only making very little money? And that's how you invite questions you are not prepared to answer. The rules that you need to know is this: commuting is personal. Driving from your home to your regular place of business is not deductible. A business mileage starts when you leave your office to go somewhere else for work. Or if you work from your home, you drive to meet a client or go to a job site. And you need a mileage log also, not just I drove a lot. You need date, starting point, ending point, mileage driven, and business purpose. Without that, the IRS can disallow this left and right. So how can you avoid this? Well, keep a real mileage log. Use an app, use a notebook, use a spreadsheet, doesn't matter, but just document it and document it precisely. Make sure you have those details of where you went, when you went, how many miles you drove, and what time was it. A good app is going to track all that for you without you having to do any of the physical work, and you can sit at the end of the year and reconcile all of that. That is what I had been doing for years. And be realistic. If your mileage seems too high for your industry and your income, the IRS will notice. That's how the DIF score works. Your numbers get compared to everyone else. You are also an outlier. If you are an outlier, you get flagged. And again, your tax preparer is just putting down what you tell them to. If you say 40,000 miles and it's wrong, that's on you. Number 4, running a cash business. If you are running a restaurant, a salon, a contracting business, retail, anything where you take a lot of cash payments, the IRS watches you extra carefully. Why? Because cash is easy to hide, and the IRS knows some people don't report all of it. So they have something called a cash T analysis. They look at your bank deposits and compare them to your reported income. If they don't match, you're getting a letter for sure. And that's when I see a lot of small businesses that are not even doing a lot of revenue, but they do have a lot of cash, constantly get letters from the IRS asking for questions because they have them flagged as businesses that usually accepts cash. We're talking taco truck vendors, we're talking small food truck vendors, we're talking small retailers that don't even do a lot of revenue, but they get flagged. Why? Because these cash transactions are one of the major things the IRS goes after. I've seen people get audited because they deposit $200,000 in a bank account, but only reported $150,000 in income. And if you can't explain that, they assume that you underreported. And this brings us to the biggest problem I see all the time, underreporting income. We're going to talk about that in detail in the next video because it's one of the fastest way to get audited and one of the most expensive mistake you can make. The rules you need to know is this: all income is taxable. It does not matter if it was cash, credit card, Venmo, PayPal, whatever. If you get paid, you report it. And your bank deposits needs to match your reported income. If they don't, the IRS will ask you a question. How to avoid this? Report every single penny, every dollar, no matter what source it is. There are better ways to write off and decrease your tax liability. Not reporting income is not one of them. And it's one of the most dangerous one that will get you in trouble. Always, always, always report all income. You will always get an opportunity to get better write-off elsewhere if you're better prepared. Use a point of sale system that tracks everything. Keep a record, reconcile your books with your bank statement, hire a bookkeeper, make sure that you are able to track every single money that's going in and going out, and you will be better prepared. Because if you do get audited and your numbers don't match, the IRS will assume you've been cheating. And then you're going to be paying back taxes, penalties, and interest on money you may not even owe just because you couldn't prove where it came from. And remember, your tax preparer is just putting down the numbers you give them. If you tell them you made $150,000, but you actually made $200,000, that's on you, and the IRS will find out. Number 5. Mismatched 1099 forms. Here's what happens. You get paid by a client and they send you a 1099 form showing they paid you $50,000. They also send the same copy to the IRS. But on the tax return, you only reported $40,000. Maybe you forgot about a payment, or maybe you thought you could leave some of the income. The IRS's computer automatically compares the 1099s they received from your tax return. If those numbers don't match, you get an automatic letter called the CP2000. We're going to talk about the CP2000 in detail in the next video. This isn't even a human being reviewing your return. It's a computer catching the mistake and automatically sending you a letter. I've seen people get CP2000 notices saying they owe $15,000 because the IRS thinks they didn't report all the income. Sometimes the person really did forget, and sometimes the 1099 is wrong. Either way, now you have to deal with it. This is another form of underreporting income, and it's one of the IRS catches automatically. We're going to dig deeper into this topic on our next video because this is one of the #1 reason people get in trouble with the IRS. But for now, the rule that you need to know is this: the IRS gets a copy of the 1099s before you even file a tax return. They already know how much income you should be reporting. If your tax return does not match that record, you're going to get a letter automatically. How do you avoid this? Reconcile all your 1099 forms before you file and make sure the income on your tax return matches what the IRS is also receiving. If you get a 1099 that's wrong, contact the person who sent it to you and ask them to fix it. Don't just ignore it and hope the IRS is not going to find out. Don't just move forward with filing the return thinking it's going to be okay. It's not going to be okay. It's automatically going to get flagged. And if you are a freelancer or a contractor getting multiple 1099s, keep track of all of them. Put them in a folder, check them against your record, and make sure everything matches before you file. And don't just send your tax preparer a number giving them all your 1099s. Make sure they match, because if you don't, that's on you and not your tax preparer. Here's what you need to remember. The IRS isn't randomly picking people to audit. They have rules and they have a system. They have a computer that scores your tax return and compares it to everyone else in your industry. If you know the rules and you stay within your boundaries, your chances of getting audited go way down. But if you're just guessing it, and if you are writing off things without knowing if you are actually allowed to deduct them, you are inviting questions you are not going to be able to answer. You won't play a game without knowing the rules. Similarly, don't put stuff on a tax return if you don't know the rules regarding those deductions. And don't think the tax preparer is going to save you. They are just putting down what you're telling them. If you give them bad information, that's your problem when the IRS comes back. Now, I mentioned underreporting income a couple of times in this video, and there is a reason for that. Underreporting income is the #1 thing that gets business owners in trouble with the IRS. It's not always intentional though. A lot of times, people just don't know what counts as an income and they forget to report sometimes. But the IRS does not care if it was an accident. They see underreported income and they assume you are hiding something, and they come after you hard. In the next video, I'm going to break down exactly what underreporting is and how it happens without you even realizing it, and how to make sure every dollar you earn is reported correctly so you never have to deal with the IRS after the fact that you have already filed your returns. And if you're not sure about any of these, Don't guess it. The team at D2 Tax can look at your specific situation and help you understand what applies to you. They offer a 30-minute consultation for a reason, not because they're trying to sell you on something, but because I know what it's like to pay for mistakes you didn't even knew you were making. I built D2 Tax to give business owner the same support I get so they can keep more of what they're earning and stop living in fear of the IRS. Click the link to the next video. We're going to dig deeper into underreporting income, what it is, how it happens, and how to avoid it. This is crucial information you cannot avoid missing.